The S&P 500 is trading at all-time highs, up more than 80% over the past 5 years. On paper, we're witnessing one of the greatest bull markets in history. But if you look at the people actually powering this economy, the data tells a story we haven't seen since the 2008 financial crisis. Consumer sentiment has been in a free fall, dropping by nearly half in that same window to 2008 levels, and breaking a decades-long relationship. For decades, sentiment in the stock market moved in unison, but not anymore. That relationship broke down after the pandemic, and they've diverged ever since. It's a divergence that suggests one side of this equation is lying. Either the stock market is hallucinating a recovery that isn't there, or the average American is about to be left behind by a permanent shift in how wealth is created. Because right now, the economy is splitting in two. One half, the stock market, is booming, while the other is just trying to keep its head above water. And cratering consumer sentiment is a major weakness for the US economy. That's because nearly 70% of the US economy is made up of consumer spending. So whether or not regular people are spending or saving can make or break the economy. And today, the average consumer is, by almost every metric, struggling. After the pandemic, the lowest income percentile saw their wages rise faster than any other group for a couple of years. But since that wage growth peak in 2022, that story is reversed. Every income percentile has seen declining wage growth rates since the peak. But year-over-year wage growth for the lowest earners have sagged to 3.6% compared to 4.6% for the highest hourly earners. Real income growth, which accounts for inflation, paints an even starker picture. It currently sits under 2%, levels reminiscent of the early 2010s when the unemployment rate was 7% and the economy was still recovering from the Great Recession. Much of the wage growth that the lowest earners did see was rapidly consumed by the rising cost of housing, food, and energy, which have contributed to a small but concerning uptick in across-the-board inflation. Rising costs and slow-moving wages have nearly wiped out the record-level savings that consumers were able to build up during the pandemic, putting the average American consumer in a vulnerable position, near the lowest savings rates on record. And as consumers have dipped into and depleted savings to cover necessities, they've inevitably taken on more debt to cover daily costs. Debt payments as a percentage of disposable income have risen quite dramatically since late 2020 for mortgages and other debt. This increase is driven by higher interest rates, which directly impact the cost of loans and credit card payments for consumers. Judging by the poor state of the average consumer, you'd think that the market must be on the verge of a total crash. If the people who drive 70% of GDP can't afford their lives, the earnings of the S&P 500 should be cratering, but that isn't what's happening. The S&P 500 rose more than 16% in 2025, and by many other metrics, the economy has proven to be resilient. Credit is actually improving, and defaults are falling, despite rising payments. That's a sign of financial health in the economy. The reason defaults remain low, even with rising debt payments, is that Americans still have jobs. They're using their paychecks to service ever-increasing debt loads, a trend supported by low unemployment. The unemployment rate has been ticking up over the past few years, rising to 4.6%, but that is still within the 3 to 5% range considered full employment by the Fed. And initial jobless claims have not really been climbing, which indicates more of a hiring freeze than a firing frenzy. And at the same time, a growing number of S&P 500 firms are announcing rosier earnings projections. This indicates that despite the bifurcated economy we're seeing, there are some optimistic signs that things could be improving. And to top it off, despite a strained consumer saddled with debt, retail sales have shown solid growth lately. At first glance, this doesn't seem to add up. If the average consumer is struggling so much, who's holding up the economy? The data shows we might be looking at the wrong consumer. While we talk about the consumer as one group, the economy is split in two, and it's the wealthiest consumers who are spending the most. The top 10% earners accounted for nearly half of all consumer spending in Q2 2025, the highest level since records began in 1989. Meanwhile, lower and middle income families are tightening their purse strings. The ultra-wealthy are also much more exposed to the stock market. The top 1% own half of all equities in the US, while the bottom 50% own just 1% of stocks and rely primarily on wages for their income. The S&P 500 has grown nearly 50% over the past 5 years, minus inflation. Meanwhile, wage growth has been stagnant over that period when you account for inflation, so a tiny fraction of the population benefits enormously from the rallying stock market compared to the average consumer who may struggle to pay rent and likely doesn't own any equities at all. This means the stock market rests on the continued spending of the wealthy few, who are benefiting largely from a rising stock market. As long as the top 10% keep spending, the engine keeps turning, but this has turned the US economy into a fragile tower. We've potentially traded a broad-based, resilient resilient economy for one that depends entirely on a small fraction of the population. If their wealth takes a hit for something like a stock market correction, there's no consumer left with the savings or the income to catch the fall. At Capital.com, we'll keep you posted on the divergence between the markets and the real economy. Hit like and subscribe to stay tuned. Thanks for watching.